Hi, my name is Monali Patel and welcome to this presentation on understanding the relationship between inventory transaction, cost of goods sold, and the financial forecasting. In this scenario, in this scenario, Parsi Omnius is a manager in purchasing department responsible for procuring raw materials for his company's manufacturing process. He and his team are measured on the cost of the material they purchase and are expected to continuously bring down costs to help the company stay competitive. Additionally, Parsi is also responsible for producing financial forecasts, which are used by executives to communicate with investors and set public earning targets. But unfortunately, Parsi's forecast for the last quarter was off by a significant margin. So, and he needs to explain the reason for the discrepancy in the vice president of operations. So this presentation aims to explain the adjusting entry that was made due to an unexpected inventory control problem and suggests changes to improve financial forecasting in the future. So for to understand the how inventory transactions are related to cost of goods sold, it's important to first understand the process of recording material cost. So when a company purchases raw materials such as like metals, chemicals, and plastics, a debit is recorded against in inventory, while a credit is made to account payable. So later, when company manufactures and ships its products to the customers, credit is made against inventory, recording the consumption of the raw material. Meanwhile, the cost of good is debited in accordance with expense recognition principles. So, it is important to note that Parsi's team is primarily preliminary measure based on the cost of materials they purchase, which is why accurate forecasting is very crucial in this case. So any discrepancies in inventory levels can have a significant impact on cost of goods sold and ultimately on the financial forecast. So the inventory count conduct at the end of the quarter revealed that the about $350,000 of polyurethane foam was missing. So as a result, an adjusting entry was necessary to correct the inventory balance and accurately reflect the amount of polyurethane foam used in the manufacturing process. So to correct the adjusting general entry made to correct the inventory balance would be to debit cost of goods sold for about $350,000 and credit inventory for the same account. So this is because the inventory was overstated by $350,000, and this amount needs to be expensed to reflect the actual amount of polyurethane foam used in manufacturing process. So this impact of the adjustment is that Parsi's forecast for cost of goods sold will be off by dollar of 350,000, and this amount needs to be, and which could be very serious consequences for the company's financial performance. So this is because of cost of goods sold is a key component of the company's income statement and affect company's profitability. So the corresponding T accounts would show a debit of $350,000 to cost of goods sold and the credit of $350 to inventory. So this adjustment would reduce the inventory balance and increase the cost of goods sold, reflecting the actual amount of polyurethane foam used in the manufacturing process. So it is important to note that this adjustment is just one time event and will not affect the future periods. However, it highlights the importance of accurate inventory management and forecasting to avoid future adjustment that could negatively impact the company's financial performances. So implementing a system for real-time monitoring for inventory levels and consumption rates to identify discrepancies and forecast changes make quickly. And for now, I'm going to give you some suggestions like how can Parsi can improve the financial forecasting in the future. So they can just implement a system for real-time monitoring of inventory levels and consumption rates to identify discrepancies and forecast changes more quickly. Then one more thing they do is providing more training and resources for the purchasing team to understand the impact of inventory management on financial forecasting and how to monitor the inventory level efficiencies. Also, they can establish the clear communication channels and protocols between departments to ensure timely and accurate reporting of the inventory data and any issue that may arise. Also, they can explore the use of advanced um, analytics and data modeling techniques to improve the accuracy of forecasting and identify the potential inventory discrepancy more quickly. So in conclusion, we discussed the importance of important role of inventory management and accurate financial forecasting in purchasing department success. We explained the relationship between inventory transaction and cost of goods sold and how inaccuracy in inventory count can lead to the forecasting errors. So we show the necessary adjusting entry for the inventory count and its impacts on the cost of goods sold and passes forecast. Additionally, we suggested several ways to improve financial forecasting in future, including regular physical inventory counts and enhancing communication and collaboration between departments. It is crucial to prioritize accurate forecasting and inventory management to ensure the company's financial success. um, Thank you for your attention and please feel free to ask any questions. You can ask any questions or give any suggestions in the comments below. Thank you for watching my video.